Imagine this. You wake up tomorrow morning, check your portfolio, and suddenly see red everywhere. The Dow Jones, down 1,000 points. The S&P 500, crashing. Your retirement savings, shrinking in front of your eyes. Scary, right? But here's the question everyone is asking in 2025. Are we heading straight into a market crash? Or is this the biggest buying opportunity of the decade? In the next 12 minutes, I'll break down exactly what Wall Street analysts are saying, the risks you need to watch out for, and the strategies smart investors are using right now. So grab your coffee, sit back, and let's dive in. Part 1. Where we stand today. First, let's set the stage. Right now in 2025, the S&P 500 is sitting near all-time highs, thanks to big tech and the unstoppable hype around artificial intelligence. Nvidia, Microsoft, Apple, these giants have pushed the market into record territory. But here's the catch. A Reuters poll of over 35 strategists just came out. And guess what? Most of them believe the market is going to stall by the end of this year. Their target for the S&P 500 is around 6,300, which is actually a couple percent lower than where we are today. Why? Because of tariffs, because of inflation, because valuations are sky high. So we're at a crossroad. On one side, explosive AI growth that could add $13 to $16 trillion to U.S. stocks in the next decade. And on the other side, political risks, slowing global trade, and the possibility of a sharp correction. Part 2. The bear case. Why a crash could be coming. Let's talk about the scary part first. The bear case. There are 3 major risks flashing red lights right now. Number 1. Inflation isn't dead. Yes, the Fed cut rates, but prices are still sticky. Housing is expensive, wages are high, energy costs are volatile. If inflation bounces back, the Fed might have to slam the brakes again, and that would crush stocks. Number 2. Tariffs and geopolitics. Global trade tensions are back. Countries are putting up barriers, raising costs, and squeezing company profits. Remember, corporate America doesn't operate in isolation. If global demand falls, earnings drop, and stock prices follow. Number 3. Narrow market leadership. Here's a crazy stat. The top 10 companies are driving more than 70% of the market's gains. That means if big tech stumbles, the entire market collapses with it. So yes, the bears have a point. The market looks fragile. And history tells us, when valuations are this stretched, sharp corrections usually follow. Part 3. The bull case. Why it might be time to buy now. Let's flip the coin. Because there's a strong bull case, too. Reason 1. AI revolution. Goldman Sachs and Morgan Stanley both agree. AI could add trillions of dollars to the market over the next few years. Productivity gains, cost savings, new industries. This isn't just hype. It's happening. Reason 2. Fed policy. Rate cuts are already in motion, and every single time in history, when the Fed starts easing aggressively, stocks rally. Investors chase risk. Valuations expand. Reason 3. Corrections equals opportunity. Here's a powerful fact. Whenever the S&P 500 drops 20%, the average return over the next 12 months is plus a 19%. That means if we do see a crash in 2025, smart investors won't panic. They'll use it as a chance to buy quality assets at a discount. So, while the headlines scream doom, the bulls are quietly saying, relax, this is the time to build wealth. Part 4. What the experts are predicting. So, what do the experts actually think? Reuters poll. Slight downside by end of 2025. Morgan Stanley. AI could fuel a 30% uplift in the market's total value. Goldman Sachs, targeting S&P 500 at 6,600 in 6 months and 6,900 in 12 months. Sanctuary Wealth predicts a 12% rally by year-end. See the pattern? Not everyone agrees, but the consensus is this: short-term volatility, long-term upside. Part 5. What smart investors should do. All right. So how should you, the everyday investor, play this? Here are 3 simple rules. Rule number 1. Don't chase hype blindly. Yes, AI stocks are hot, but that doesn't mean every AI company is a good investment. Stick with proven leaders. Rule number 2. Diversify smartly. Don't just own big tech. Add exposure to utilities, real estate, and high-quality dividend stocks. These sectors do well when rates fall. Rule number 3. Keep cash ready. If and when the market corrects, that's your chance. History shows the biggest wealth is built during downturns. Don't be 100% invested. Stay liquid enough to take advantage. So, is 2025 the year of a crash or a golden buying opportunity? The truth is, it might be both. We could see a painful correction, headlines full of panic, portfolios bleeding red. But for those who keep their cool and buy high-quality assets when fear is at its peak, this could also be the chance of a lifetime. Remember Warren Buffett's famous line, "Be fearful when others are greedy, and greedy when others are fearful." So stay sharp, stay patient, and when the storm comes, be ready to act. This is Dollar Vest, helping you make smarter money decisions. If you found this breakdown useful, hit that like button, subscribe, and share this video with a friend who needs to hear it today.